All right, all right. Welcome back, guys. Live at 5. My name is Jeb Smith. With me, I have Josh Lewis, our mortgage expert. This is the Educated Home Buyer. We use this time to help educate, empower, guide you through the real estate and mortgage process. Again, what's the saying, Josh? To buy right, borrow smart, build wealth through real estate investment and financing. So that's the reason we're here. Josh, welcome to the show.
I hope I didn't make you fret too much. I told Jeb I was having computer problems and I was going to restart, and I made it back in with 14 seconds to spare. So I'm sure he was in a full-blown panic because
Oh,
he
I was
couldn't
just so
couldn't do
worried.
it, couldn't
I was
possibly do it
worried.
without me.
I was worried. So let's talk about what's happened in real estate and mortgage over the last week. Not really a lot on the real estate front, at least here locally, right? Many of you know I'm in Southern California. I always talk about inventory levels. Inventory has gone up. It's come back down. Today we sit, Orange County, 1,261 properties, about where we were this time last week. Huntington Beach, 92 properties. So I saw both significantly higher 2 days ago, yesterday. So Wednesday seems to be kind of the lull in the inventory, because I think what happens is properties typically probably come on the market about Thursday. And then by the following week, properties are kind of put back into escrow about this period of time. So, but we're following it each week the same time to give you some real numbers on that. So, Josh, on the mortgage front, what's happened? We got some, a lender came out today with some aggressive program that we can talk about that, may help generate, some business for one, but also help buyers in certain price points get into certain properties. Let's talk about interest rates, where the market's going, any other updates, and we can kind of go from there.
Absolutely. So the program you're talking about, for those of us here in Southern California, the world has got increasingly crazy here, and lots of communities going above the high balance loan limits. Inland areas like Riverside, San Bernardino, lots of Central California, where a home can easily go into the $750,000, $850,000 range above standard balance limits. This is the United Wholesale Mortgage. You've heard Jeb do videos about them before. We talk about them before. Pros and cons. There's some really good things about them. They're the 24,000-pound gorilla in our industry. So when they say they're doing something or announce something, it's perceived as the first and newest and best. So there were a couple of other lenders doing this, but they're jumping in and doing jumbo loans with as little as 3.5% down. Now, again, you have to be very well qualified, a 720 FICO score, only up to a $1.5 million loan amount. But we ran the numbers out earlier today. The 3.5% down actually doesn't make sense, and I'll tell you why. At 3.5% down, the best rate had about a 2-point cost. And if you did 5% down, that goes down to just under a 1-point cost. So if you figure it 3.5% down plus paying that extra point, you're already at 4.5%.
Right.
You might as well just do the 5% down.
And if you don't have the 1%, then you shouldn't be buying a house.
Yeah, and it's a little bit crazy that we're in a market. I don't know if you guys saw at the first of the year, or actually in November, when the new conforming loan limits got announced. They took a huge jump in high balance areas. You can do a $970,000 and change loan. And there were op-eds in business pages in every newspaper across America. What is this world coming to? The government is helping millionaires buy homes. Just to put it into context, we had a viewer of the show here that we just closed their purchase about 2 weeks ago. It was $1,050,000 purchase and a $950,000 loan. These aren't rich people. These aren't the people that every newspaper in America was screaming that the government is helping wealthy people push prices to the moon. They were in a nice entry-level neighborhood in Los Angeles, and that's what the number looks like. Jeb, the thing that blows my mind, because when I'm out on Zillow, I look at oftentimes homes in Huntington Beach. So it pulls up and it tells me every day I get a digest of 10 homes that I might love in Huntington Beach. It is almost impossible in Huntington to find a home under $1 million. The ugliest, smallest, most beat up home. And I remember when my home went over $1 million, and it wasn't that long ago. What would you say, Jeb? Probably 2014, 2015, we're like, hey, because we peaked, my house peaked right at or right below, somewhere plus or minus $1 million in the last run up. So it was probably around 2015. We're sitting there, hey, my home's worth $1 million again. Now every home in our city is well over that, and some fairly Spartan homes at 1.2, 1.3. So we are in interesting times, and the financing is getting interesting. So having lower down jumbo options is going to help people get into properties. Jeb, something that we haven't talked about on the show, I don't know if you did do a video about it or not yet. The response from the government to getting yelled at for doing $970,000 loans backed by Fannie Mae and Freddie Mac is high balance loans above 640,000. They have added a loan level price adjustment, which is an additional cost to you. A purchase with less than 25% down, which is almost all of our high balance purchases that are going to Fannie Mae lenders, costs an additional 1 point. So not a percent in interest, but a point in cost. So if you're buying a $1 million home and you're putting 10% down, getting a $900,000 loan in Los Angeles. Here in Huntington, where we're saying that's about as cheap as you could possibly find. So your entry level Huntington Beach home, that $900,000 loan, you can either pay a 1/4% higher interest rate, or you can pay a $9,000 fee up front. That was our government's reaction to getting criticized for offering giant loans to millionaires. And I know every day, Jeb, didn't we, like when we got the new loan limits announced, didn't we show the map? If you look at the map, it's pretty much California and then a bunch of little pockets around the country. If you're in San Jose, California, if you're in LA County, if you're in Orange County, you're in San Diego, even Ventura, like these are not rich people. There's a reason why the government decided to offer high balance loans, and over time the political pressure is just pushing it. So a long way of saying it's getting really expensive with rates already up for folks to have to pay this additional premium that the government has put into place, and it actually goes into effect April 1, and we are February 23rd. It's for loans delivered to Fannie Mae April 1 or later. So almost every lender is charging those fees already.
No, and I did mention it in a video. I think it was the one that came out Monday, is that it's something that nobody's factoring in. I mean, the fact that, interest rates have gone from low 3%, say around 3%, to basically 4% in the matter of 5 weeks, 6 weeks, somewhere in that ballpark. And at the same time, you're going to have a potential 1/4% hit to the rate that nobody has even seen coming. It is going to make an impact. Now, the majority of the United States, again, isn't impacted by this. And many of those people are probably looking, going, yeah, that's what California deserves with the crazy people out there buying those homes. I mean, probably some truth behind that as well. But
maybe they have a small point.
Yeah, I mean, so let's be honest. But either way, it is something it's going to hit people, and it's going to factor in. But here, what we need to discuss, the Orange County, there's a local title rep who studied economics in through his through college, a smart guy, and puts out a report that I subscribe to, and a lot of local agents here subscribe to. He made a point in the one that came out yesterday, and he says, listen, we've had rates rise, and supply hasn't basically moved. We need interest rates not only to rise, but stay there for an extended period of time. And this, I'm not telling you anything I haven't said before, but he goes back and references it to back in 2013, when we had a similar dynamic in the market. Now, it wasn't as hot as it is now. There was a lot of different factors, but rates at that time were in the high 3% range and ended up pushing up into the 4s, and everybody thought that was the end. Rates are never going to be lower again. They're never going to come back down. Inventory started to build, but it didn't rates didn't stay there. Rates pulled back down, and guess what happened? The market continued to accelerate. So there's a lot of factors playing into the market right now, guys, and you just make sure you're paying attention to it all, right? You're not just reading the headlines. I mean, for those of you who actually watch my videos, another thing that I read last week, and I put in a video, and I thought it was something good to mention, is that the cost of living here in Orange County, where I'm located, went up by 26% in a year's time. And that was before rates had actually peaked. So the Orange County Register, our local newspaper, did a story on this. And at the time, rates were about 3.75. Rates are now around 4%. So at that time, the cost of living, because the median home price has gone up, because interest rates have gone up from where they were this time last year, about 26%. That's a big number for a lot of people out there. The question is, can it, will it impact supply? Will it impact supply? Because that's what we got to find out. Until supply builds, nothing changes.
No,
So,
Jeb, something that you and I had talked about, a guy that I've followed since the 90s that has as good a handle on California real estate as anyone is a guy named Bruce Norris. He's out in Riverside, but he runs numbers for every county in the state of California. He did his quarterly update. I pay for a subscription to that and sat last Saturday through a couple hours Zoom of him walking through this. And he's going through numbers and he's saying, historically, we're approaching where somewhere in, say, the next 6 to 12 months, we would hit a wall for price increases in California, not Southern California, California across the board. So, of course, the hands start going up, people asking questions, because basically it's a group of investors. It's not first-time buyers, people wanting to invest in real estate. So they're all asking, okay, cool. So we need to start getting our money ready so we can buy these discounted properties. And he says, here's the difference between the current market and the last corrections. And then the last time we didn't have a correction, we had a crash. And he said, here's the difference. Prior to 2007, 2008, a downturn was characterized by 30 to 40% of the market, homes available in the multiple listing service, being bank-owned properties, real estate owned.
foreclosures, right?
And in 2007, 2008, that number was like 75 to almost 80%. And you saw an even bigger drawdown. He says, I do not see, for various reasons, where in the world we're getting any foreclosures and distressed properties coming from. Says, Jeb has talked about this, the amount of tappable equity in homes, but the average loan to value on mortgaged homes nationwide is 47%. With the big appreciation in the last 2-3 years, anyone who didn't buy in the last 6 months is not only sitting on their down payment, but large gains over that time frame. And these are the best underwritten loans in 30, 40 years in terms of high credit scores, lower loan to values, everyone qualified. So when you look at that, there can absolutely be forced sales. So you could see downward pressure on prices. You could see a prolonged period of flatter prices. This is all assuming what Jeb was saying earlier. This is all assuming that we get additional supply. Because even though we're saying these are the historical things that have led to either flat or slightly correcting prices, if we don't have sellers deciding to sell their homes, it doesn't matter. Like where we're coming from is we have 20 people wanting every one house that comes on the market. If tomorrow 70% of those people don't qualify, then we still have 6 people forbidding every house that comes on the market. So we're so far out of balance that we're a long ways from that leveling out. And absent the bank-owned properties, banks having hundreds of thousands to millions of dollars tied up in a property that they don't want. They don't want to hold it. They're not going to rent it. They want it off their books as quickly as possible. You're not going to see that big downward pressure in prices. So it's an interesting market, and trying to project what happens next, where we go, is very difficult from here. Jeb and I do our best every week. We're reading, analyzing, looking forward, but it's a tough market to project.
No, absolutely. And, I can't believe it's taken me this long to mention this, since it's been the pain in my ass for the last 24 hours. And that is the podcast that Josh and I mentioned, a couple weeks ago now, is actually live. The Educated Homebuyer is the name we went with. You guys helped pick that out. We took it to heart and actually named it that. So you can find it. It's on Spotify, it's on Apple, it's on all of them. If I get a minute, I'll put some links here in the chat so you can go find it. But here's the deal. This isn't the same content that we do here. Okay. It's not my videos. I don't take my video and just transcribe it and throw it into a podcast. I felt like that would kind of be cheating the system to some extent, right? Because you guys, a lot of you watch the videos. Why would you want to hear the same thing? So some of the information is covered, but it's in a different way. And all of these include Josh and I as of now, right? And unless Josh bails on me and I start doing them by myself. So we're having some dialogue like we have here, some going back and forth, some answering questions. The one that was posted yesterday, should you buy a home in 2022? Something you should listen to. We go deep dive into this. I mean, we talk about maybe it's not the best time for everyone to own a home. So again, I'm not going to sit here and pitch it the whole show, but I did want to mention it because you guys support us, follow us. You guys know other people that may be buying. So pass it along. Again, just trying to provide value, provide information, and guide you guys through that process. So Josh, anything you want to add before we dive into some questions here?
No, that's enough. And just relating to the podcast, it gives Jeb and I more of a format. This is really about you guys. We take the first 15, 20 minutes and talk about where things are at, what came up in the last week that's interesting, and have this discussion. The podcast is really more of us to pick a topic, go deep dive, and just bounce it off the two of us. Not that we can't field questions or you can inquire there, but really just the difference here is we want to go through your questions in this format, and the podcast allows us to go deeper on topics that are often triggered by the questions that you guys ask here.
Now, in addition to that, we're also going to be having guests on, right? It's not just going to be Josh and I. We're going to get some people on in different states to talk about different investments, different markets, the hot markets that everyone has a problem, or not a problem with, the ones that everybody thinks have peaked, the Austin, Texases of the world, the Phoenix, Arizonas, the Boise's, we're going to talk to people, agents on the ground that actually do business there, and have some conversations, because I think that's value can be added, because you can see what's happening in all markets, not just here in Southern California, even though I try to build it outside of that. So let's go and start. We got a lot of compliments on beards and just in general. So I like those, and I want to read them. So we got slick beard, slick hair, slick info, nice beard. What do we got else? And I'm going to put these up here just because I like looking at it too.
Because I like hearing it.
I like hearing it. I like reading it. It's all good stuff. So anyhow, we appreciate the compliments, but more importantly, appreciate you guys being here. So Michael starts with, what's the best neighborhood in Orange County for families with a budget less than 1.5 million? So, honestly, Michael, you're pretty fortunate because Orange County has a lot of great neighborhoods with really good school districts for the most part. I mean, not all school districts in Orange County are great, but I would say as a whole, Orange County has pretty good schools. So with that budget of 1.5, you could, I could cough in the microphone and blow your eardrums out, or you could move to an Irvine. You could live in a Huntington Beach. I mean, there's a lot, you have options. I think you need to get more specific than, excuse me, more specific than what's a great neighborhood. What's important to you in that process? Wow. Sorry, guys.
Just to follow up on what Jeb's saying, there are truly a lot of cool communities. So you want to look in terms of, as Jeb said, schools, what amenities are important to you. I live in Huntington Beach. I never touch my toes to the sand, but I love driving down PCH and seeing the ocean. If that's important to you, maybe you like it. If you want a warmer climate, maybe you're out in Rancho Santa Margarita. Right. You even have the issues of further for us here up in Northern Orange County or down to South County. Very different areas, but other than the super expensive stuff along the coast in Corona del Mar, Newport, that type of stuff, almost every community is available to you in that price range, right, Jeb?
No, for sure. Yeah, I mean, that's what I was going to say. If you're looking to be close to the beach, there's beach locations. If you want a great, like, super family-oriented neighborhood, a lot of families, like Ladera Ranch. If you want to be on a golf course, there's a lot of cities that have golf courses. So, I mean, it really depends. If you want to live by Disneyland, you have annual passes. You can be out in Yorba Linda and some of these other markets that are closer to there. You could be in Anaheim as well. I mean, you have options. So you have a good budget, a healthy budget. I think you need to dive deeper on the other things that are important in that process to really figure out where you want to be. Happy to have the conversation if you don't have anyone. So feel
Jeb,
free to reach out.
The second house I ever flipped in my entire life was in Anaheim. I believe it was on Amstutz. I'm not 100% certain, but like the first night we were there, we're like, this is rad. It was on the backside of Disneyland, right where they light off the fireworks, and it sounds like a war zone, and you can see them right over your head. And what I quickly learned is about the third time you were there and it sounded like a war zone and the fireworks were going on just over your head, local residents get tired of Disneyland fireworks really quickly.
All right. Good stuff. Good stuff. Let's see here.
We
Some
have a more of an announcement here than a question, but someone got her closing disclosure 9 days before her closing date of March 4th. So does that mean next week? No, we got one more week. The week after that, we'll have the celebration. We'll have to have confetti come down on the screen, and we'll have champagne and cake and stuff to celebrate Jennifer getting her home.
we'll do it here, right? And just she'll watch us.
And she'll watch us eat the cake for her celebration.
Actually, what we should do is she should get on a computer and a laptop in her new home, and we should have her on the show to celebrate. So
It's a
Jennifer,
plan.
you hear that? That's an invitation. So let us know. But no, congratulations. That's awesome.
Jeb, she's sort of like the Wizard of Oz right now. Like she's behind the curtain. I have no idea. She just seems like this big monolithic thing that's just everywhere at all times. So it might just ruin the illusion if we had her show up on screen.
Exactly. It might be your wife. Who knows?
Yeah,
she might have bought a house in Indiana.
Yeah.
Let's see. So Caroline says, if I'm looking for a house in the 275 range, should I hold my search for another year? I think it depends on your market, right? 275 in some markets goes a long way. I'll tell you, like I had someone reach out to me here locally and he watches the show or did. I don't know if he still does after my email. But he's looking for a property. He wants to be by the beach, 2-bedroom property somewhere close to the beach for $350,000. Unfortunately, there's not a lot of those out there, right? That's a unicorn in our market. Now, if you wanted to go inland, you wanted to go maybe some areas where it's not so great, properties aren't so great, you could probably find one for 350, but it's not going to be it's that type of property here isn't the type of property that we're, that sees the appreciation, that sees, the things that we're talking about. A lot of them have high HOAs, they have mismanaged funds because they're condos, and there's a lot of issues with them. So that in this market is very difficult to find. I won't say it's impossible because anything is possible. It's just that's difficult. I would say, unless you're willing to sacrifice on bedroom count, maybe go to a studio and or willing to go different location, it's hard. I'm not going to tell you not to look. I'm just going to tell you I don't think I can help you. So that would be, if you were saying 275 here locally, I would say that's a unicorn. If you're telling me 275, but you want to live in New Mexico, that might be a possibility. I don't really know. So just that's the what you have to figure out in having, and answering that question. So and Josh and I don't know the other markets, right? Like I'm looking at some property right now in out of state for investment purposes. 275 there, get you a nice house, really nice house. In fact, the price point that I'm looking is somewhere between that 200 and 250. So there are markets that definitely support that price.
It's sort of like the show, Jeb. What's the one on HGTV, the hometown, where there's somewhere down south? Is it Alabama, Mississippi,
I
Laurel,
haven't seen it.
Mississippi? And like they buy houses for like $50,000 and fix them up for $100,000, and for $150,000, people end up with really cute little homes. So it's an interesting thought, and hopefully some of those little towns like that can come back as people decide, hey, I don't need to pay $1 million for a 2-bedroom house in California. I'm going to Laurel, Mississippi.
There you go. So Peekaboo Daisy. If I buy a single family house in March, when can I refinance? So Josh, somebody buys a house now, how soon can they refi?
Nothing prevents you from doing it the day after you close your loan. So it has to make sense. There has to be a valid reason for it. The lender's always going to ask us, why are they doing the loan? What is the tangible benefit to the borrower? Certain types of loans, both FHA streamline refinance and VA interest rate reduction loans, have waiting periods, generally 210 days after either you close or your first payment, depending on the loan type. If you want to use the new appraised values, that's been the big question the last few years in this market. We can't use the new appraised value on conventional loans for 180 days after you close. So really, you're probably not going to do anything for the first 6 months, but the loan has to make sense. So So if you're trying to save on your payment, either the value has to gone up where you're at a lower loan to value, or rates have dropped, and we're still shell shocked with our PTSD from the last 6-week moonshot up in interest rates. So hopefully you're right and that happens soon. I don't know with the inflation readings and the Fed plans for the next 6 to 12 months that that's coming anytime soon.
Got it. So I'm going to go a little bit further and address the question. If you buy a house now, how quickly can you sell it? Right. I had somebody reach out to me and ask that question because they got a job relocation, bought a house. Now they have to move. It does. You could sell it the day after you buy it. There's nothing preventing you from doing that. As I mentioned here, on the show last week, I believe, home here locally, Irvine, the clients bought it about 18 months ago. I think October or so of 2020. We just put it on the market, and 30% increase from when they bought it. I sold it for 1.1 million. 1.1 million. They bought it for 735. So it's a year and a half, just over a year and a half. Is that realistic to happen over and over again? Absolutely not. You should not be buying a house expecting anything like that. That was a blessing from God that happened. And no one could have ever predicted that. So if you're buying a house with that in mind, probably buying for the wrong reasons. But just you could sell it or refinance it as soon as you close either. Josh, rates on VA conventional today. Now, this is going to take many factors into play. VA, obviously 100% financing, many of them. Credit scores, they allow lower credit scores without really a big impact. But conventional, there's a lot of factors that we need to know there. But let's say best borrower out there for both of those, roundabout number.
3.5 on the VA, and possibly a little bit lower, 3 3/8, 3.25 if you want to pay a little bit for it. But the conventional is right at 4%. I mean, your absolute best qualified borrower with a big down payment or a low loan to value might be clinging to that 3.99 level. I'm looking at the Optimal Blue Mortgage Market Index right now, and they're showing it's about 4.1. That's the average locked rate, 4.1, 4.15 for all of the lenders that use the Optimal Blue system, which is probably 60 to 70% of all lenders. What they're locking on a day-to-day basis is 4.15, and it varies. If you're a sub 680 credit score, it's 4.5. If you're a 740 score, it's 4.042. So that's what Jeb was saying, where it varies a lot. The VA, you can with a 680 plus credit score, you're in that 3.5 range. You're not paying any lender fees, probably getting a little bit of a lender credit. Maybe you get it to 3.375. So a question sort of behind the question there, if you're asking about both, there's a lot of people out there that will try and talk you out of using your VA benefit. The only reason to not use your VA benefit is if you were putting a big down payment and you wanted to avoid the VA funding fee. So a conventional loan with 20% down doesn't have mortgage insurance, doesn't have a funding fee. A VA loan doesn't have mortgage insurance, but unless you have a service-related disability, you're going to have a funding fee, and it can be fairly large if you've used your VA benefit before. So it's a subsequent use, and you're putting zero down. It can be a lot of money, but I just hear all the time people trying to talk other people out of using their VA loan. It is very rare that a conventional loan is better for a veteran than a VA loan.
No, good stuff. And you mentioned something that I'm going to put something here on the screen in a moment, but people get quoted rates, right? And whether or not you go to a broker, a bank, whatever, we always talk about, just making sure you're getting the best deal, whatever that means to you. Sometimes it's the best rate. Sometimes it's a great rate with great fees and great communication and expertise. I mean, it can be a number of things, but there's websites out there, for example, like I'm going to pull this up here, Josh. And if you look at this, it shows that a 30-year fixed rate, right? This is Optimal Blue. This is what you were mentioning a moment ago, right? If a consumer gets to this website or somebody gets quoted a 4.25% interest rate on a FHA rate, and and then the buyer somehow ends up at this website and says, "Oh, well, that makes sense. It says it's 4.25. I got quoted 4.25. Seems like a pretty good deal." This, like, interest rates are significantly, like the conforming and the 15-year, probably pretty accurate. The FHA isn't accurate at all. And tell me why it's different, right? This is the Optimal Blue website's a little bit different because of how brokers are locking
E-
loans. Isn't that right?
Exactly. So almost if you're looking at those conforming rates, um, we should explain by saying who uses Optimal Blue. Mainly direct lenders. And that doesn't mean that they're actually loaning their own money. Most direct lenders, let's just pick a company, say like a guaranteed rate. Guaranteed rate, for the most part, doesn't loan their own money. They have giant warehouse lines of credit. They can make tons of loans and then they sell those loans off. But they use a system like Optimal Blue for their internal pricing and locking and managing that entire process. So 4.15, it's not far off from what we would do. I could be a little bit better than that, but fairly competitive. And that's not capturing the points and fees included there. But what Jeb is talking about is the FHA. And Jeb, if you click down below, you can turn on VA also down there under the primary mortgage indexes,
Oh, yeah, there you go.
indices. So it'll throw the VA into the chart also. And you're also going to see that that's high. And you're like, why are FHA and VA high? Historically, they always had been. After the meltdown, investors in mortgage bonds realized that buying Ginnie Mae pools of mortgage bonds were fully guaranteed by the US government. Now, the US government stepped in and guaranteed Fannie and Freddie pools in the last market, but there was no true guarantee. The government didn't have to do that, they chose to. So once people realized that, yes, there's a little greater risk in FHA and VA loans, but those are fully guaranteed by the government, they said, maybe we should pay more for those. So since we're guaranteed of getting our money back, unless the economy, the whole government implodes, we're going to get our money back. So from that time forward, we've always been about 0.5% better on government loans, FHA or VA, versus the conventional loans. So if you have anyone quoting you and showing you those numbers, or if you go to a direct lender, for the most part, they use government loans, the big profits on government loans, to subsidize the thin margins they have on their conventional loans. So by all means, shop around on your government loan. If you're getting a VA loan and you go to any of the big call center lenders that you see advertise online and talk about how they love veterans and help them, really high rates, really high margins. And Jeb, you pulled that down, but another thing I was going to point out there, I don't know if you noticed that the jumbo rate there is about 0.25% lower than what you're seeing on conventional loans. So for all of those high balance loans, most jumbo lenders will not make a loan on a standard balance loan, so up to 640 and change. If it goes above that, we're in the high balance range, you generally have the choice of going jumbo. And with those high balance hits that we were talking about, with the overall market where it's at, if you qualify jumbo, you're going to get better terms. So we're doing a lot more jumbo loans versus high balance because of what the government's done with the pricing on that here recently.
All right, good stuff. Just wanted to point that out, right? We're here to educate you guys, and I think it's important to know, why you see some of these fees. I mean, everything on the internet's not true, guys. So just make sure you're doing your due diligence. So in that meantime, over the last couple of minutes talking and stuff, Oscar came in, became a member. Appreciate that, Oscar. Appreciate the support, as well as Christina popping in to give us compliments on the thumbnail. I don't even remember what I did with this thumbnail. I do now. Thank you, Christina. Christina, another YouTuber that does a lot of housing information, a lot of affordability, addresses affordability, talks about it. So go check her out if you're not familiar with her there. So let's get back up here, Josh. We had a good question on, let's see. I saw it just a second ago and not. Here it is.
Is it this one? Go. You got it.
I don't know. We're just going to go with this one. It's a question that a lot of people ask. I think it's something that need to address at the current moment. It's not even something that's feasible. But Josh, why don't you enlighten us on why this can't happen? So the question is, with home values increasing, do you think lenders will start offering 40 and 50-year loans? Now, someone recently said in my video that I think it's Japan or China or somebody out there does loans like 40 and 50-year loans. So could the U.S. follow suit?
So here's the issue. The last time we had a market on fire like this, the mortgage industry responded with very creative options: interest-only loans, 40-year loans, 50-year loans, negatively amortizing option arms, and then shortly thereafter, the market imploded. So the government's response, they're always fighting the last war. They looked up and said, "We'll fix these guys. We'll tell them what a qualified mortgage is," and it basically gives lenders safe harbor from getting sued. Um, any loan longer than 30 years falls outside of the QM guidelines and you lose those safe harbor protections. So it will be at a higher interest rate because those loans can't be sold in the same qualified mortgage pools. So the higher interest rate generally offsets the benefit of going out to 40 or 50 years. So absent the government changing the qualified mortgage regulations, which is possible, we're now what, 13, 14 years since they passed that stuff. And when they pass it, I go, we'll never see any changes to that. They talk about maybe some changes at the margins. For the most part, the guidelines, the regulations were good things. There could be some small tweaks and improvements, and maybe that means bringing a 40 or a 50 year back. But I don't expect it to happen anytime soon.
Yeah. Now, what this off the wall question here? What if you have a big company out there, a UWM, for example, that has the ability to probably service a lot of their loans, not even sell them to Wall Street, and says, "Hey, we're going to start doing 40 years, and we'll just keep them on our books." That's something that could happen, right? In
Absolutely.
theory,
So
yeah.
an investor has to step in and say, we're okay with the additional risk of these not being qualified mortgages. We think this is a good book of business. This is how we can serve the market, and we'll do it and we'll hold the loans. It's not against the law to do them. It just doesn't meet the definition of qualified mortgages. So it's riskier to the investor, and those investors are still getting a premium for that. But, kind of, Jeb, going back to what we're talking about, how jumbo loans are more competitive than high balance right now. Part of the government whacking those additional loan level price adjustments onto high balance loans is them saying, we don't want the government through Fannie and Freddie to be as big a part of the mortgage market as it is right now. And we believe that private investors will step in and fill that void. And they are, to a degree, for the people with 740 plus FICOs and at least 20% down. The jumbo options are better than high balance, and they're pretty darn attractive. So from that end, it's kind of working. I don't know. I've got issues with it, and we'll see what happens. We saw when COVID first jumped off, within a week, every jumbo investor was out of the market. So we saw that in the meltdown in 2007, 2008. The reason why we got high balance loans to begin with is there was no market for borrowers who needed large loans. And the government said, well, we have to have this or we're going to have an even bigger problem with our housing market. So they stepped in and did it. So things change over time, and we'll see what happens. When things are good, I think private investors, big business will step in and make those loans. Anything goes sideways, and it's going to go back to the lender of last resort, which is the U.S. government.
Good stuff. 298 people watching. Going to take a minute here and just ask a favor. If you find any value in tonight's show, you get your question answered. You like our beards. You don't like our beards. Hit the thumbs up. Helps more people see it. Helps us accomplish the goal of educating home buyers, trying to provide that value and make it a more streamlined and easier process to understand. So we appreciate you being here. And now back to our regularly scheduled programming.
So Jeb, this is the question that I thought you were going to, and it's a good one. Fallen Angel says, my loan officer says 3.99 is good and still at an all-time low. Well, that's not true. The all-time low is about 2.5%. So near in the ballpark, in the vicinity of all-time lows, possibly, historically, nearer the low end of the range than even the middle of the range. So that's accurate. And is it a good rate? Yeah, 3.99 is a good rate. My bet is at 3.99 to try and tell you you're not paying 4%. They have you paying some points to get that. And then you threw in, my sister bought her house in 2014 and the loan rate was 3.75. Why did my loan officer say it is fine to buy now? The interest rate doesn't have anything to do with whether it's fine to buy now. So we have, is it fine? Sure it is. Can you qualify? Does 3.99, do you have the money to pay the closing costs? And do you qualify? Can you get that loan? cool, it's fine to buy. You go back to the question of, is it a good time to buy, and is it a good time for you to buy? Those are very different questions. The way this is being posed, the way you're asking the question, it sounds an awful lot like you're not talking to a mortgage expert, you're talking to a loan salesperson who really is wanting to convince you that everything is okay. It may be, it may not be. There's a lot more to that question.
No, and that is something that you just mentioned. When is a good time to buy a house? So it's when it fits your life. Right now, it doesn't matter where home prices are. It doesn't matter where interest rates are. If it's the right time in your life to buy a house and you're plan on being there 5, 7, 10 years, whatever that number is, you're not planning to leave in 2 years. You got money in the bank. You can afford the payment. You're not stretching yourself. Now is fine. You're going to look back and be grateful that you bought a house. But if you're somebody that's constantly watching the market, reading the headlines, wondering, I'm not buying until the headline tells me it's a good time to buy, you won't be buying forever. I mean, because the reality is, if and when home prices start to come down, which at some point in the future they will, right? Not crashing. I'm not a crasher, but home prices have to adjust at some point. They can't continue on the path that we've seen. The reality is, as home prices come down, depending on how quickly that happens, the people out there that should be buying, that have wanted to buy this entire time, are going to be the people that sit there and watch as home prices go down, thinking that they're going to continue to go down, and then they're not going to step in until it bottoms out. And by the time they think, it bottomed out, the market's already picked back up. That's what happens, right? As home prices retract, pull back, correct, whatever you want to say, the investors are stepping in. The smart money is buying real estate because, again, we're learning, and if you're not, you should be. Real estate is a hedge against inflation, and inflation is real. 7.5%, 8% a year isn't real. Right now it is. It's, but that will correct itself. But each year it's going to get more expensive to rent. It's going to get more expensive to live. Fixing your costs by buying a house 30-year fix is the best hedge against doing that. So now could be the best time for you, or based on your situation, maybe it's not. But here's what I'm going to do. I mentioned the podcast earlier in the show. Go search theeducatedhomebuyer.com, or The Educated Homebuyer, not .com, but you could go there too, on any, podcast platform, and listen to the episode 3, where we talk about, should I buy a home in 2022? We give you everything you need to know to make that decision. So another plug, yes, but it's good information and something that, hey, I listened to it and I thought it was great. Hey, how about that? Josh?
Well, yeah, and my wife listened to it and she thought it was great. Jeb's wife refused to listen to it. She says, I'm not interested in hearing my husband's teeth rattle.
Yeah, exactly. She doesn't like the ums and all of that goes along with it.
So, Mr. Jeb, there's a good question here from a member. Yep. Jeremy Malaise says, are you familiar with Sunday, and what are your thoughts on it?
Malice? I'm not familiar. The only Sunday I'm familiar with is one that might come from Dairy Queen.
Okay.
I don't even know. Are you familiar with Sunday?
I looked it up real quick. I've heard of them. So here it is. Sell as is fast for the best price. Compare cash offers from vetted local investors. No repairs, updates, or showing. Pay zero fees. So Jeb, why would I go to a new startup website to get offers from vetted local investors when I can list with Jeb, and those vetted local investors can come and make the same offers through a realtor?
Well, I mean, I guess the first thing that comes to mind there is, when I heard you say that, is they're saying they're not going to charge you any fees. So that would be why someone would do it, right? They would say, well, if I can just get a cash offer from an investor or multiple investors, why pay the fees? The reality is, you don't need me, or any agent for that matter, to get that. But what an agent could tell you is what your house is truly worth in the condition that it's in, and then put it out there for more people to see by putting it on the MLS. Sunday, if it goes with a company like that, my assumption is that it's not on the multiple listing service. It's not on a platform where the exposure can really go up, right? I mean, you want to create demand, right? Demand drives exposure, or it's the other way around. Exposure drives demand, demand drives price, right? So you need more property, you need more eyes on that property to get the demand there. The more demand, typically the higher price. I'll give you an example. Occasionally, I come across properties that need a lot of work. Buyers or sellers will reach out to me saying, "Hey, listen, you know, deferred maintenance on my property." I go look at it and I'm like, yeah, unfortunately, you're not going to be able to get financing on this. They don't want to list it because they're embarrassed or whatever. They don't want to put it on the multiple listing service. So they come, we have a conversation. I say, hey, listen, I actually have a group of investors that may be willing to buy something like this, right? Occasionally I'll bring Josh in. I'll say, Josh, come in, and he'll say, this is what I think it's worth. It's my job as a real estate agent to also get other investors that are potentially interested in it. Josh is my friend, but just getting his idea of what he would pay isn't doing my client the best service, in their best interest. So I often get other investors out there. Sounds like similar to this platform, to come and offer on it. What I will say is the more people that view that property, typically the higher price I end up getting. Why? Because Josh wants to go in, and Josh's margins, he's probably being a little bit conservative on some of his stuff, what he can sell it for, what his costs are going to be, how much time it's going to take to do it. And then you might get somebody out there that just never flipped a property ever, watched the show, said, you know what? I know I can do this. It's not going to cost me that much money. I've got some extra materials. I'm just going to go in there and do a basic job, not really fix it up nicely, and just turn around and sell it quickly. That person might be willing to pay more money for it. And I've seen it time and time again. And by putting it on, say, the MLS and having more eyes, more exposure on it, I'll tell you, people will pay a number most often, or more than likely someone will come to the table with an offer that is beyond anything reasonable in the situation. Sort of like the
in the
property I
current
just sold in Irvine.
in the current market. But not even that. That was a nice, relatively fixed house. A fixer upper, like I just tell you, anyone that would put the home in the MLS, someone will make an offer far beyond what is reasonable. As an investor, I have to look at it and go, what's it going to cost to fix? How long do I have to hold it? What does that cost? What do I know I can sell it for? Not hope, dream, imagine. And that number has been wrong the last few years because the market's going up so fast. So, aggressive people have been out there saying, I'll pay you, thinking that when I'm done with this home in 120 days, it's gonna be worth 10% more. And they've been right over the last few years. So it's worked out really well. Different markets call for different strategies. And Jeb, I dug in here. So Sunday does not charge directly the seller anything. Sunday charges the investors. So when the investor says, I'm willing to pay X, you as the seller see X minus Sunday's fee. So we can say you're not paying it, you are paying it, because when it goes into the MLS, I'm going to make my best offer. You're going to see what it really is. And Jeb or the listing agent, whoever you enlist to help you with that, is going to say, after your fees, here's what you're going to walk away with. The net is the net is the net. I'm not saying this is a bad business model. It could be a great business model, and it could be a better way for people with distressed properties to sell. But there's no reason why this gets you any more as a net than a realtor does. They both are valid ways of getting to that. They're both marketplaces of investors who buy distressed properties. That's the important part when you're trying to get top dollar.
I think what a lot of homeowners don't understand is that there's a lot of cash out there. You don't need to go to a website to try to get a cash buyer. You don't necessarily need a cash buyer to close quickly, right? People think, well, I need money now. My house is destroyed. This is the quickest and easiest and maybe the only way to get it done. No, there are so many opportunities. In fact, I think I mentioned this on the show a couple of weeks ago. I looked at a property here in Huntington Beach. The guy called me, and basically a situation where his brother-in-law is becoming incapacitated, can't take care of the property. He said the house is in disarray. Like, it's just really bad shape. Can you come over and take a look at it? Tell us what it would sell for. We're not in a position to fix anything up, probably going to be cash. I get over there and I'm like, dude, the house is fine. Like, cosmetically, there needs to be some things done, but overall, I could have a line of buyers out the front door. Like, you don't need to fire sell this property. You don't need a cash offer. If you want one, I could get you one, but you'll be leaving money on the table. So again, it's self-serving, but having an agent there that understands the business, knows the business, especially in this environment, is super important. So just make sure you're doing your homework when going that direction. Fallen Angel says, thank you for the honest opinion. Appreciate you answering my question. So appreciate you being here. Thanks once again. So Josh, I saw some other questions up here I wanted to get to. Coinster, also a normal, regular viewer. I like normal, but regular works too. 6% end of the year is 6% end of the year rate, and still high demand, tight inventory, a far-fetched scenario. So I'll go first and say, yes, I think so. I don't think rates could get that high and demand stay that high, personally. I think if rates got that high, demand would drop off, inventory would build, the market would slow. Now, is that going to happen overnight? Absolutely not. These things take time to work out. This isn't a scenario where, demand picks up one day and all of a sudden the market draws, stops tomorrow. Why I talk about inventory every week with you guys at the beginning of the show is just to show you these are the trends that's happening in the market. Right now, we're not seeing any change in that trend at the moment. Now, if every week we start to see property rise, something to start paying attention to, right? At the moment, rates have stabilized a little bit. That's something to pay attention to. If they continue to go up and up and up and up every week, we got a problem on our hands. But Josh, what are your thoughts on that scenario?
Let's address the 6% end of year rate. So right now, the spread between the 10-year Treasury, which we talked about, mortgage rates and mortgage-backed securities closely follow the yield on 10-year Treasuries, but it's not an exact relationship. Sometimes the spread is bigger, sometimes it's smaller. Right now, we're a little over 2%, which is the high end of the range. Over time, that will likely decrease and go back to something more normal. But let's look at the 10-year Treasury. We ended the year, our low level in the fourth quarter of last year is 1.34. So in the last quarter, we went from 1.34 to we closed today at 197. So it's a 0.64 increase.
You got a chart for me, Josh?
Yeah.
Let's throw a chart up here. Instead of stalking numbers, let's look at something. Sorry. I just think it's helpful for people to see what we're looking at.
Let's just share.
And while you're waiting,
were you going to sing to him?
I was going to sing some songs.
So here's the 10-year Treasury. So, whoa, went crazy.
What'd you do?
I don't know what I did. Let's just get back to it here. So if we go back, where were we when I'm saying we were at 134? We were in this range here back in December, early December. We're bottomed there at 134. And so 3 months, we're now up just under 2%, and mortgages right at 4%. So we have a spread of about 2% there. So if you want a 6% mortgage rate, you have to have a 4% 10-year Treasury. So we just went from 1.34 to 1.97 over the biggest, most rapid rise you've ever seen in 3 months. I shouldn't say you've ever seen, because historically it's not all that big, but because we were coming off such a low base, they're 50% higher. Treasury yields are 50% higher than they were 3 months ago. We would have to have that happen every quarter this year to get to 4%, which would get you a 6% mortgage rate. So I don't see any world in which that happens. It would put massive brakes on the economy. You would see a lot of the high growth tech stocks would get crushed. We're talking about the Fed hiking. A good friend of mine, excellent investment advisor, excellent financial writer, has been talking about this, that it's all well and good that the Fed says we're going to raise, we're going to raise, we're going to raise. As soon as the economy cracks, as soon as those Fed hikes cause a 20% correction in stocks, they'll back off of it pretty quickly, because they've shown for the last 20 years, they, in addition to their actual mandates of stable employment, stable inflation, and employment, they've also taken it upon themselves to make sure that the stock market doesn't have too much downside volatility. Since 2008, we haven't seen anything more than about a 20% correction. So I don't think that's going to happen. the Fed would have to be hell-bent on raising rates and ignore everything happening, and inflation would have to keep roaring ahead. So some of you think inflation is a big issue and going to stay here. If we get a recession, recessions are deflationary. So you will see inflation go away immediately. That's great that in 2021 we had consumers flush with cash from the government giving it away through 2020 and 2021, looking to spend it like drunken sailors. As soon as we get a tight economy where home values level off, stock prices drop, they're not going to be spending money, and you will not see inflation. Now, we can also talk about the fact that our government somehow thinks it's a good idea to have $6, $7 a gallon gas and to be dependent on energy from all around the world. That can be a factor that keeps inflationary pressure, but high stock prices, high home prices would be a thing of the past with a 6% interest rate. So long way of saying no, not going to happen.
All right. Ashley says, market season is quickly approaching. Do you see the prices settling or do you see them spiking? So market season, I assume, talking about the spring market. I think locally here in Southern California, prices are going to continue to move sideways to up, probably up, just because of the lack of supply. Until you see supply increase, we've said it time and time again. I mean, this time last year, we had over double the amount of properties on the market than we have at this time. And last year we were saying there's no inventory. What are we going to do? And now we've got half of that. The 3-year average of inventory on the market this time of year, and I'm going to misquote this, but it's somewhere around like 3,500, 4,000 properties. We're significantly below that average. And that average is going back to 2019 and prior. So until something changes with that, you're not going to see much change in the market. There's a lot of cash, lot of people looking to get into real estate for many different reasons, and because of that, demand is remaining strong. Joanne says, she put this earlier when you were talking about Bruce Norris, but says forecast by Jeff earlier was 17.4% increase in sales with peak in May and then plateau. So who is Jeff? Is that me? Am I Jeff?
You might be Jeff. I don't know.
Okay, I might be Jeff. To my housekeeper, I'm Jeff. She's for 15 years, she's called me Jeff. She knows my name. The checks have Jeb on them, but Jeff is my name.
Passive aggressive. Maybe she just doesn't like you. She wants a bigger Christmas tip.
Should be El Jefe. El Jefe. Anyway, too much? Maybe. Dennis says, just lock my interest rate at 4.375 for a new construction. Do you recommend considering buying points to lower the interest rate when I get closer to closing? So how's that work, Josh? Buying rates?
A couple things, Jeb. We talk about this a lot on the show. In terms of paying points to buy a lower interest rate, I'm not a big fan. Going back to 1982, 40-year bull run in interest rates. Every 2, 3, 4 years, we get a nice refinance market. Don't pay for an interest rate that point is going to have a 5, 6, 7-year break even. And we're going to get a chance to get that lower rate, probably even lower than the 0.25% lower at some point in the next 2 to 3 to 5 years. And yes, in the current market, I still believe that to be true. The Fed will step in at some point when we hit a recession, and they will take rates back to zero again, and we'll have another opportunity to refinance. But the bigger question is, what is a point? A lender does not care what interest rate you pay within the range of what they find acceptable. On any given day, they say, here's the market rate, we want this. So let's say if today it's 4% is the rate that a lender wants, and you go, well, I don't qualify at 4%, I only qualify at 3.75. What is your option? You pay 1 point. A point is a percent of the loan. So in this instance, let's say it's a $400,000 loan. If you want to pay 1 point to go from 4% to 3.75, it's $4,000. So what happened? The lender said, okay, we'll take a 0.25% less every month, but you're paying 1% more up front. So you're prepaying the interest for the first 5 years or so on that loan. And from their perspective, you may know I'm going to be in this house for 20 years and I'm not going to refinance. You may think you're not going to refinance. From the lender's perspective, they're making 10,000 loans. They know across 10,000 of them, on average, they're going to sell off in about 5 years. Either someone's going to sell their house or refinance. So that's where they're looking at that break even. It also works the same in the opposite direction. If you say, hey, I need some help with my closing costs, I'd like some money. So if you say, I'll pay you 4.25%, they go, cool, we'll pay you 1% to do that. So they give you $4,000 to cover some of your closing costs so you can get in. Again, to them, it's all the same. They say, we want 4%. We'll either take a higher rate and pay you for it. We'll take a lower rate. You pay us for it. So the big one with new construction, Jeb, let's just throw the old chart back up since you're such a fan of charts today. This blue line here, the only thing you need to know is you see we hit it on the 10th. We hit it, what is it, 1, 2, 3, 4, 5, almost hit it there, 1 day break. So 7, 8 of the last 9 days, we've hit that line. As long as that line holds, we can hope, expect, believe that rates are going to get better. Now, are they going back up here? No, they're not. But when you see this move, this line here is a Fibonacci retracement. Long way of saying markets, when they have a big move in one direction, they often correct. And Fibonacci levels are magical levels. And I do mean that, it's magic, the way they work, that oftentimes we would see that 38% retracement, which would be a 1.5 better in this case. So there's no guarantee that this level holds. But for all of my clients who are in new construction with 60, 90, 120 day timeframes till closing, we're watching that. If we dip and close below that blue line, we're going to lock. If we stay above it, we're benefiting, even if we stay in this tight little range here that we've been in for the last 10 days between this red line and this blue line. If you stay in that range, you're still getting closer to your closing and need a shorter term lock. So that's a benefit. The only way we lose here is if we fall below that blue line, and we'll lock everybody if that happens. So more information than you wanted in that regard, but it's just the way we look at it.
Good stuff. Yeah, we got a lot of people asking about locking rates, that sort of thing. Here's what instead of getting into each one of these, lock the rate. If you're comfortable with the payment now, you're comfortable with the situation, lock it. You should lock it and just move on, not look back. And potentially, if you're buying new construction, there's a float down option. If you're buying new construction, you're months out, lock the rate now. Start talking to some people 30 days out, 45 days out prior to closing that property, and maybe move your loan. It's not ideal, but if you want the best rate, the best terms, the best fees, the best service, there's some, it's something that you're going to have to do some work to probably get it, just because of the direction. And if the rates move higher, you've got security. Fair? Josh, is that fair?
Yeah, no, I wouldn't disagree. What I can say is most people are risk averse. If you're the person that when you get to Vegas, you can't wait to get to the blackjack table, maybe you're someone that is comfortable floating. Most people aren't. And that's the way I ask people. When you hit, yeah, that guy. So when you hit Vegas, what's the first thought on your mind? Is it the buffet, the pool, the spa, or is it getting to the blackjack table? And that tells you whether you're comfortable locking. For most people, they would rather deal with lost opportunity than actual lost money. So what Jeb was saying in terms of locking, never a bad idea. If you qualify and you're comfortable with the payment, take the risk off the table, and then you can just focus on the fun stuff of buying a home.
Good stuff. For all of you Apple users out there, you have your pretty little Apple phones. I put the link to the podcast in the chat there. I pinned it at the top so you can find it. For us Google users out there, well, guess what? Android, Google hasn't approved it yet. So you have to go to Spotify or some other platform, podcast or Pocket Cast or one of those to find it. So Penny Pinch Home Finder always makes this comment on every video I do, and it's a good comment. That's why I'm putting it up here. Everyone has options. Stop renting where you want to live, buy where you can afford. Great content, and beggars can't be choosers. So I appreciate the great content, but yeah, if you can't afford to live by the beach and you want to own a home, you might have to sacrifice location to do it. Now, I'm one of those people that says don't sacrifice, but you got to figure out what's important to you in this process, and what's your non-negotiables, if you will, and decide whether or not it's the right move.
And I will say, think about it. What's a common move that's not even a terrible one for people here in Southern California? Is going out to the Phoenix area. And I say not a terrible one because it's 4 hours away. But if you live in San Clemente, California, and you got priced out of the market, you may determine that going to somewhere where it's 110 degrees in the summer is a terrible move. Some people love that. They want to be at the pool, at the golf course, no problem. But you may have parents, children, grandchildren that are local here, and being 4 hours away is just an unacceptable
Dude,
thought to you.
the better question is, how are you getting to Phoenix in 4 hours?
Bro, I'm a professional road tripper.
Jeez.
You're a jet setter. I'm a professional road tripper. I drive. We can't afford to take private jets
Dude,
everywhere
you
like
ain't getting
Jeb
there
and
in
his
four
family
hours.
do.
I'll put money on that any day. You
Let's
leave
go.
right now.
Let's
No
go
way.
tomorrow. Let's go tomorrow. You and I will
Not
drive
a
out there. I'll get
chance.
that 4 hours each and every
I'll
time.
film it live.
Let's go. We'll live stream it.
Yeah.
We can
4 hours
talk.
of
We can
content.
talk and answer questions for 4 hours when I get us to Phoenix. So
Not a
Jeb
chance.
says Jeb
It would
thinks
actually be 6
how long is
hours
it?
of
6
content.
hours.
5.5 hours, I think, is about right.
6 hours. Good
Five
Lord.
and a half.
Regardless, that's not that far of a move away. You can drive back in a half a day if you're Jeb, in less if you're a good driver. So from that perspective, like a lot of people just say, I'm not willing to do it. I won't do it. Financially, for your long-term well-being, home ownership is that important because yes, you can say I can still afford to rent right now, but at some point you're going to want to stop working and rent is going to be a lot more expensive 20, 30 years down the line when the end of your working years come. That's why home ownership, we talk about it a lot here, like people are like, I want to get rich. I want to build up a bunch of equity. I want to be like Jeb's brother-in-law and make $330,000 on my house in 14 months or whatever it is. That's not the reason. The big reason is financial security of getting a home paid for and arriving at retirement, knowing all I got to do is pay my taxes and insurance, and I have a roof over my head. And in worst case scenario, if you didn't save enough money elsewhere, if you get your house paid off, you do a reverse mortgage and they give you money that you can tap to live off of. So it is a key element of building wealth and financial security over the long haul. So not building wealth, just financial security, a home base for you, literally.
Good. Jeff Liu. Oh, did I have that question on there? The money seems to suggest that using an agent that reps both buyer and seller provides competitive advantage for buyers. Your honest opinion. So, in some regards, the answer is yeah. But what I'll tell you is that I had multiple buyers reaching out to us to represent them on the property in Irvine, and guess what? None of them. They didn't even make offers because what I saw the offers and told them an idea of where they would need to be price wise in order to even be competitive. They weren't even close. So yeah, it can help you get to the bottom line, but I mean, at the end of the day, there are some advantages to having your own agent, especially in the negotiation phase and other processes, throughout the transaction. So I wouldn't say it's definitely a gray area having the listing agent represent both sides. You need somebody that is fully, not only transparent, but able to treat both sides with almost as a fiduciary in regard to making sure they both get what they're supposed to get with regards to a negotiator, a deal maker. And I will tell you 99% of the time, agents out there aren't doing that. So just know that there are benefits to having your own agent in the process.
Jeb, here's the way I always like to explain it to people. If I'm the greatest attorney in the world, if I represent both parties in any legal proceedings, I'm not an attorney anymore. I'm not representing anyone. I'm a mediator. I'm an arbitrator helping them come to common ground. And you may say, well, that sounds awesome. That's just not how I am. Real estate's a zero-sum game. I want the best deal for me, and I think they should want the best deal for them. Imagine that you have an agent representing both sides. And I'm not saying this is a terrible thing. It's not. It's not a terrible thing. But I'm saying, let's say we get into it and there is a big and valid dispute over a repair. What's going to happen when you ask the agent, are they going to go, let me go and negotiate, I'm going to get this covered for you? No, they're going to go, let me go talk to the seller and see what common ground, middle ground we can agree to. And you may say, and you may be right, that in the current market, that's a win-win for everyone, is finding the common ground. I just want someone representing me, and I'm cool that they have someone representing them on their end as well. I don't want a mediator.
No, to each his own. And sometimes that person representing that property has no idea what the hell they're doing. Trust me, I'm seeing a lot of it at the moment. And so I'm almost doing their job for them. So you coming in as a buyer, they're representing you and the other side. That's going to be a world of hurt for all parties involved there. So just make sure you know what you're doing. I can't say it's a bad deal or a good deal either way. It's each situation, each scenario is going to be a little bit different. Let's see. Michael Sizemore says he's out of the market. So Mike, hopefully rates come back down. You have an opportunity to get back in.
Jeb, let's just unpack the second part of that. First of all, like my first response is, okay, that's a crazy response. That, I mean, taken out of context, 4% rates are really good. We just answered that question for Fallen Angel. Historically, a 4% rate is really good. So to say, I will just be a renter rather than locking in a home at today's prices, which are elevated, all the things that are leading you to that, neither Jeb nor I are going to say those are invalid and not accurate, but you'll just rent for life. Okay, you're going to rent for life. What is your plan for taking whatever savings you're seeing on a monthly basis, saving and investing it so you have a big enough nest egg to cover your rent when you're 70 years old and don't want to work anymore?
No, absolutely. You don't have to be a homeowner, but I mean, a homeowner will get you to greater financial wealth, generational wealth long term. And I have a friend actually
No,
that
you
has
don't. No, you don't.
I have no friends. That's rented for a very long time. He's worth a lot of money. I don't know how many millions, but multiples of millions, factors of it. He chooses to rent. He moves. He, currently living in Bali, Indonesia for the last 3 to 4 years, not tied to anything. Financially, he's going to be okay regardless of what he decided to do. So if you're in that position and you want to rent, by all means. He's choosing not to own. Now, he's owned multiple properties. Recently moved around and done some other things, so he doesn't own anything. So you've got to make the decision in what's right for you. If financially you think, security wise, you don't need the house for the nest egg in the future, and you shouldn't be buying a house for that reason anyway. But as you pay it down, it becomes that for a lot of people. Just, have an alternative plan. That's what it comes down to.
Renting is not an invalid option. Anyone that tells you, oh, you're stupid, or that's not a good option, or don't do, it's just don't do it because it's better today without a plan for tomorrow. Know what it means for the long haul and plan and prepare for that. It means you have to have more savings when you arrive at retirement than someone who owns their home free and clear.
Yep. All right. So, so many of these questions are the same. And I realize that people are just like to that point where they're, feel misguided, don't know what to do. I'm going to address it here in a minute, but I wanted to break this up a little bit. Purchased in July, 3.375. Been debating on refinancing in hopes of appraising well enough to get rid of the PMI. Would it make sense to do it? So in this market, chances are your rate's going to be higher than what you have now. Chances are your home value's gone up since July. Now, has it? I don't know how much you put down initially, but you did a conventional loan. So, how much has it gone up in that 8-month or so period? Hard to say. I mean, the property that I just sold in Irvine ended up appraising. Josh, I didn't tell you that. It appraised. It appraised, bro. Like shocked.
That's amazing.
Like mind blown that it appraised. So there are properties out there selling at high value. So you might actually be able to get rid of that PMI, but getting rid of that PMI, your rate going up, what does it make sense right now to do that? How much is that PMI versus how much your payment's going up? How much is it going to cost you to do that? All of these are things that you need to consider during that process. How long is it going to take you to pay back that cost of doing that if there is cost involved?
In the next 12 to 18 months, at the rate property values have been going up, you'll be able to have an appraisal done, go to your lender, show your on-time payment history, and get that mortgage insurance removed and keep your 3.375 rate. Even
There you
with
go.
paying points, you're going to be 3.875 or higher. I wouldn't do it. And I do think, again, in the
Good
next
point.
1 to 5 years, we're going to have a recession. Rates are going to go back down. You may have an opportunity to refinance at that time. So you have two potential outs to get rid of it in the future without giving up your excellent interest rate. I wouldn't do it. I wouldn't refinance it.
There you go. Is this our friend Beatrice Sanchez here? Betty
Ah,
Sanchez? Did she close? Did she get to the bottom line on her deal that she was working on?
we're getting close. We're not
No.
closed, but we are getting close to it.
All right. I don't have an update on that, so I need to keep in the loop. But Betty reached out to us, needed a lender, talked to Josh, needed an agent up in the market that she was in. We referred her to someone. Hopefully there was some miscommunication there for a little bit. So hopefully we got her situated and she's having a good experience. So appreciate you being here.
Jeb, here's a good
Yeah.
question here, and this a version of this comes up, and this I would love if we had a true full blown credit expert on the show to answer some of these questions. But I need a construction loan, credit score 714, not a bad score by any stretch of the imagination. Trying to get to 740 to get a better rate. I have a car note that was 17,859. I paid it to 10,000 on the principal. Do you think that will help my score go up? We can do when we pull someone's credit, we can do a what if analysis. We can do a wayfinder. There's a couple different ways to approach that of saying, hey, what would it take to get to a 740? What would happen if I paid this down? Paying down or even paying off installment debt usually has no impact on your credit scores. Revolving is a much higher impact. You would probably be better off eliminating any revolving debt. You may not have any, or you wouldn't have thought of it, or you wouldn't have thought of going this route, as I should say. I don't know that you're going to see much benefit from paying down installment debt like an auto loan.
There you go. Good thing to have Josh here because that stuff I am not privy to these days. Etnia, Etini, I
Etienne.
Etienne. All right, just hit the local. Just hit the local. Just hit the local
he's
bar. It was great. Had a
he's
great
local
time.
now. He's a
No,
Jeb Smith local.
just hit the like button, subscribe with notifications. Be like them. Them. I don't know what the right pronoun to use in this situation is. Just hit the like button and subscribe, and it helps. So thank you guys for doing that. How much will everything is about interest rates, fears of rising rates, when's a good time to buy a house?
At risk of sounding redundant, go to the podcast. We did a really deep dive, episodes 2 and 3, or is it 3 and 4? 2 and 3. Go check them out. We do a deep dive on, is 2022 a good time to buy, and what does it mean? When is it a good time? A lot of it comes down to, is it the right time in your life? Much more so, can you afford? Can you qualify? And is it the right time in your life? And do you have a longer term time horizon on it?
Yeah, so that's the question Life with Liz asked a moment ago. And then there's a variation of it up here. Bobby's asking, would you buy? Trying to buy in San Diego was outbid 5 times. One buyer went $170,000 over the asking. You know, Josh and I talk every day. And, you know, something has to give at some point, right? This can't continue where home prices continue to go up and up and up and no supply. Now, the question is when and by how much and all of those factors. And unfortunately, we can't answer those. But what I can tell you is if you go out and find a property, you make an offer, and you're comfortable with the payment, you got that time horizon that we talked about a moment ago, I think now is a perfectly good time to buy a house. Now, is there better times to buy homes? Absolutely. There's better times to buy a home. But is it a bad time? I don't know that it's a bad time unless it's a bad time for you personally based on your life situation and your, all of the other factors that we had in there, right? I think you've got to take a lot of things into account when deciding whether or not to buy a house. So, take all that into consideration when making that offer. Like, I mean, for example, I've had a buyer here. He's a cash buyer. This is a different situation, but a cash buyer. And I've been outbid multiple times. I think we probably put in 5 or 6 offers over the last 2 to 3 months. And there were offers with loans that beat us. There were offers, and we were going above the asking on every one of these, making strong offers. We just got into escrow Monday of this week. It's taken some time, but finally we were able to get there. We had to go above the asking price. But there were 4 other offers. There were actually 2 or 3 offers right after ours. But the agent said our terms, what we offered, were best fit what the seller wanted, and they ended up choosing us. And there were offers a little bit higher. So it's not an absolutely stretch to say that you can't get in when people are doing crazy things, but you just got to keep at it, stick to your plan, don't sacrifice, don't, get caught up in the hysteria of everything, and just do what's right for you. And, I'm a big believer that things work out the way they're supposed to for many reasons, right? And so if that means you don't get one house, then that means there's a better opportunity coming, or something else to benefit you in some way. So just stick to your plan, and I believe that it'll work itself out. So that was very inspiring, Josh. I should bottle that up and sell it.
That was your Tony Robbins.
Yeah. I should bottle that up and sell it somewhere. So Josh, I saw something I wanted to click and I don't see it. If you see something, hit it.
Look for it. This is a super quick and easy one. Julie Rocky says, how do you check for mortgage rates? I really like the Optimal Blue Mortgage Market Index, which everyone can find. It's publicly there. We talked about it. If you're looking at an FHA or a VA loan, talk to a broker and take about 0.5% off what you're seeing there. But those are honest, real numbers of rates that lenders are locking. If you go and you're looking at Bank Rate or any of the other sites that talk about rates, they're either trying to get you to fill a lead form to sell it to 4, 5, 6 different lenders. And to do that, they're putting numbers that are insane. Even Zillow, I got a notification on one of my properties of saying what the current value is, and I look below and it says refinance now with Zillow Mortgage, APR 2.991. Like, what are you talking about? Like, it doesn't exist. So a lot of what you're seeing is advertisements, inducements to fill out a form, connect you with the lender. Optimal Blue MMI, it's not perfect, but it's real numbers that real lenders are locking on a day-to-day basis, and you can sort it by credit tiers, so you can see, hey, if I have a 680, I'm not going to get the absolute best interest rate. It gives you a better idea of what it looks like.
Good stuff. Ingrid said, would you buy a mobile home to put on 75 acres of land while you wait to build later on? Prices to build are way too high. If it's the right move for you, absolutely. Why not? I mean, sure. If you own the land, I mean, there's some nice, there's a lot of nice manufacturer stuff out there. Hell, I mean, maybe it's not nice and you're okay living in it. That's okay too. There's nothing wrong with buying it. What you have to understand is, in these sort of situations, like, there's a difference between mobile and manufactured and all of that. I get it, but don't expect that to appreciate like, a stick built actual, constructed house. So just know, getting into it, that, that home that you're buying for the time being is probably not going to be worth much when you have to move it and whatever, or not going to go up in value, if you will. It's kind of like a car to some extent. If you're not selling any land with it. So as long as you're okay with that, you're comfortable, you've got water run to it, you don't have to plumb for sewer or electrical or any of that stuff, and you have the access to be able to do that, sure, great. Why not? To each his own.
Have you ever gone down the rabbit hole of some of the YouTube channels that do reviews of the manufactured homes?
I haven't, but I can tell you, I was back in North Carolina a couple of weeks ago, and dude, I drove by an old a place that used to sell like mobile homes, manufactured homes. I kind of lump them in together just because that's what I grew up with, but many of them are manufactured now. And dude, I looked over and I saw this house. It was like a 2-story like monster on the lot, and I was like, what in the hell? And I was like, there's no way that was like a mobile home or a manufactured home. I thought maybe the guy built himself a home on the lot where he sells them. And so I was talking to my dad as we were driving back by. He's like, no, that's where they are these days. I'm like, holy cow, man. That thing is like, it was a probably 2,500 square foot house thing was huge.
No, they're some of them are amazing. Like I've never seen one that you would look at from the outside and go, "That's beautiful." They're fine. They don't look great from the outside, but you walk inside, you're like, "This is a luxury home. I would be absolutely cool to live here. Absolutely cool to live in one of these."
No.
Jeb, we may have found the comment of the night, and you skipped over it, so don't get mad at me for putting it.
Yep.
The irony here is killing me. The California snowflake says we've insulted
Oh,
them.
this clown. He's been in here before throwing absurdities around.
It's factually incorrect. Well, if you say something is factually incorrect, it should actually be incorrect. People sat at home in 2020 and could go nowhere and spend money while the government was putting checks in their mailboxes. Throughout 2021, especially the first half of 21, all of that money got spent. A lot of that money got spent. And with limited supply chains, we have demand through the roof because of money that was given away to consumers who spent it like drunken sailors. So sorry, Snowflake, that I'm hurting your feelings again. And that is what has pushed inflation higher. As that money works its way out of the system, as supply chains normalize, the inflation that we have not had for the last 30 years will go back to inflation that we don't have. The only inflation that we do have is due to high energy costs based off of the people who are currently holding office in Washington deciding that they want to make gasoline and gas and petroleum related products so expensive that we don't have any other option. So we've now reached this polarization where we whipsaw one back and forth, back and forth, back and forth, just like executive orders get overwritten the next time the other party gets in the White House. We'll go back to having lower energy cost, and then we'll just sit here and go back and forth and back and forth. So snowflake
Yep.
away.
Hope that snowflake melts.
the,
Not going to with the weather we have
irony of
outside.
that being your name and then being, I'm insulted. I'm a snowflake and I'm insulted.
Could go down a rabbit hole there.
Yes.
How is real estate hedge against inflation? Fed is going to bring down inflation with rates. So when rates go high, houses crash. No, with no inflation. So listen, we might be in a deflationary time here soon, but typically on average, what we see about 2%, just under 2% inflation annually, Josh, for the last, I don't know, 10,
years.
12 years, 20 years. Yeah. So every year, whether you hear about inflation, the cost of things go up, right? So we're in a time now where people are really talking about inflation because of car prices, because of meat prices, because of, the bottlenecks, if you will, and not only the bottlenecks in supply chains like that, but the meat packers, right? The meat distribution companies that where they couldn't work beside each other in these companies to deal with cutting meat and boxing meat and getting ready to ship meat, and therefore they couldn't keep up with demand on this stuff. So supply just got hammered, and now you have issues where the cost of things have gone up. Yes, the cost is going to come back down on a lot of those things as the bottlenecks work themselves out, but you're not going to see, the hedge against inflation is that you have a fixed payment that you make every single month. It doesn't change based on other factors in the economy, right? Your housing expense, your mortgage payment stays the same. Now, in some areas, some markets, outside of California, your property taxes fluctuate based on what homes around you are doing. Here in California, for the most part, they don't change very much. But even when the Fed gets inflation under control, you're likely not going to see rent prices pull back substantially. You're not likely to see home prices pull back substantially because that is a supply and demand factor. Inflation is playing a part in some of that stuff, but it is not the key driver in why you're seeing supply low and demand high. And so even with the Fed controlling these things, you're not really likely to see much change there. And at the end of the day, I don't think you're really going to see rates go very far either. So there's a lot of things going on in that question, but I don't, real estate has always been the best hedge against inflation, and it will continue to be because the cost of living is going to get more expensive. Josh, anything?
No, you're right on with that. So here's the thing that I'll go to. So inflation is now a monster problem. Why? the Fed has been trying to get inflation up for the last since the last downturn in 2008 with no success. They couldn't get it up over 2% consistently, and now we're supposed to believe that it won't go back down to 2%. The same long-term issues, structural issues that took inflation down to that low level will come back into play. It's not a good thing. I mean, there's a level of inflation that's probably more like 3% that is good for everyone over the long haul, in that assets are going up in prices, wages are going up in prices. We got some weird stuff going on right now. And I don't think any of the underlying fundamentals have changed. You have two things that could lead to higher inflation going forward: government policies making energy incredibly expensive. That's inflationary, and that could be permanent if our government decides they want to inflict that much pain on our economy and our citizens. And the other one we talked about last week is supply chains being really dependent on China. And not just the US, but economies around the world are saying maybe we should bring as much production back closer to home as possible to make those supply chains less fragile. That will increase the cost of goods. Those are the two things that I could come up with that would tell you that inflation would be higher. Does that make for 5% inflation? Does that make for 10% inflation? No, it doesn't. So time will tell, but I this isn't my wheelhouse, but I tell you, I read a lot, and I read a lot of really smart people, and I read a lot of both sides of the equation. And there are some smart people who do believe that inflation is going to be an issue. Having read all of them and all of the arguments, I'm not even close to convinced that anything has changed versus 2 years ago, besides the two issues that I just told you about.
There you go. Good stuff. Maybe one of the best comments of the night. Gabby D just followed the podcast. So thank you, Gabby, for doing that. Again, there's a link in the comments there to do that for Apple. I'll throw the Spotify one up here in a minute when I get a chance. But Jennifer Lego came in and gave us 411 and give us the 411, saying it's time to lock in by hitting the like button. So guys, hit the like button, subscribe if you find any value. I know a lot of you guys show up each week, trying to just, again, give you information in ways that you can understand it and actually apply it, right? I mean, a lot of the stuff that we're getting here is stuff that you can apply when making offers, when having conversations. So we've had so many success stories of people watching the show, being referred to across the country, whatever it is, and actually getting to the finish line. So we appreciate the people that actually follow through. And then my wife would call the other people assholes, the people that just ask and then
Oh,
don't actually,
assholes! I get
yeah,
it.
don't
It's a
don't
pun.
don't actually follow through. She says I'm one of those. I'm one of those that goes to a restaurant and I already know, like in my head, like 2 or 3 things that I want, like on the menu, and I ask the server every time, "So what do you recommend? What do you think's great?" And they mention their things, and they don't mention any of the 3 that I wanted to hear, and I still pick one of those. I just wanted them to confirm by saying, we're like, "Hey, we're on the same schedule here," and they don't mention it. I'm like, still got to go with mine. Yeah,
So
I'm that
Jeb,
guy.
I have a buddy
I
who
tip
was
good though. So
the worst example of that before he and his wife got divorced. His wife and my wife were good friends. We were good friends. Every time we would go to a restaurant, guy loved Sam Adams. He would never order any beer but Sam Adams. Every time we would hit the table, what kind of beer do you have? And the poor waitress would go through the long list of stuff, and you go, okay, I'll have a Sam Adams. And you go, dude, every time it's a goddamn Sam Adams. Why do you ask what the beer? I just like to hear what they have.
there you go. So there's a link on the bottom of the screen if you need a referral to an agent, a real estate professional, mortgage professional anywhere in the United States, Guam. If you need one of those, reach
Guamanian.
out. We'll connect you and get you connected with somebody that can guide you in the right direction.
And Jeb,
So,
just
yep.
let me just piggyback on that. For those of you, if you are somewhere that you need a realtor and you don't have an expert, I can tell you almost a lot of the deals that we have in California come from the channel. And if it's outside of our wheelhouse here, Jeb is going to connect them with the realtor. We've had realtors in Lancaster, in Bakersfield, in Los Angeles, Redding area, Fresno. And I will say that Jeb's network is awesome. And from our end, there's nothing worse than working with a loser realtor. And unfortunately, we have clients who are awesome borrowers who pick loser realtors. I can tell you, I've never had a bad experience working with any of the agents that Jeb has connected the clients to. And I will say one of the most important things, my job is hard here in terms of maxing numbers and making sure we can get you qualified for what you want. The job of an agent working with a buyer in the current market, you guys have point out every week how hard it is to be a buyer in the current market. Imagine if your job was working with multiple buyers and dealing with that 2x4 to the face every day. So long way of saying it's a great network. I've had nothing but good experiences with the pros that he refers.
There you go. Appreciate that. RD, what happens when employers lower salaries due to all the remote work? Why should I pay $200,000 for some finance guy to sit in Florida versus New York City? Because someone else will. Employers are not going to, if anything, employers are having a difficult time finding good workers and willing to pay more for those workers. That's what we're seeing in the market at the moment. And remote work is just, I mean, that is going to be something that is, is going to be part of the equation for a lot of people now. Remote work, a hybrid type schedule where you don't have to go in. That's unfortunately, if productivity is there, they've actually figured out that productivity is there with some of these surveys and things they've done from people being able to work at home. Now, the creative aspect is diminished a little bit because you don't have people congregating, being able to work together, like-minded, and say like in a coding environment, that sort of thing. But a finance guy that's probably not really talking to other people during the in the office during the day, doing his thing, head down, working. Why do you need to be in an office to do a good job? So I don't think that's going to change the dynamic at all. I think if anything, companies at the moment are looking for good qualified workers that, and even if they're remote, people are willing to pay for that. So might be wrong on that, but that's, when I go around and people are telling me, I was back in North Carolina, help signs everywhere. Here in California, every place has a help wanted sign. Now, a lot of these are in the service industry, but companies as well. I mean, I have friends that own companies that are saying, "Hey, listen, we can't find good qualified people to do whatever job it is." So it's not just limited to one industry; it's across the board.
Hey, Jeb, we had a good
Yep.
two-part question here that I think is valuable for sellers, so I want you to answer it.
Yep.
Nicholas Alderman says, I just listed my house yesterday, suburb of LA, open house Saturday. My realtor called today and said, we have an all-cash buyer who wants to see the house tomorrow. Jeb, if the all-cash buyer who wants to see my house before the open house makes an offer above asking, would you take it or wait to see what happens with the open house?
Here's my advice. I just had this situation. And so I listed a property, similar situation. Buyer came in, wasn't an all cash deal, but the buyer came in, said we wanted to make an offer, and they were willing to pay more than the house was worth. My client basically said, here's the deal. If they want the house, this is the number I want. And went quite a bit above the asking price and went back to the seller, said, hey, if you want me to pull it off the market, stop the open houses, this is what you need to pay. The buyer agreed to it, ended up being a deal that closed. Now, here's what I will say. I tell sellers this all the time. If a buyer is willing to buy your house for cash, for example, at a certain price prior to it coming on the market, chances are they're still a buyer after it comes on the market, right? So they're probably not going to go away. They can threaten you, whatever, but the end of the day, they're probably still a buyer for your home, even if it's at that price. So I think there's no harm in waiting to go to the market and seeing what you get, especially in the environment that you're in now. I think you're probably leaving money on the table. Now, if you don't want to do open houses, for example, like one of the offers we just put in recently that got accepted, the seller was over doing open houses. They have pets and whatever, just didn't want to deal with it and made a strong offer. And they were like, you know what? We'll take it. We're willing to take it. We don't want to deal with going through this process anymore. That's a little bit different situation versus you've already planned for it. It's ready to go. No harm, no foul in putting it out there and seeing what happens. But again, you could throw a crazy number at them and say, hey, listen, you don't want me to show it, to anyone, whatever, you give me this number, I'll accept it today. You just have to be comfortable with it, not play the what if game in your head of, after you go through the process and have regrets. So that's the double-edged sword, if you will. So I don't think there's anything wrong with either direction. Just know you're probably leaving a little bit on the table unless you throw a crazy number back at them.
Got a fun one here. Someone
Yep.
missed all the conversation. Moppy Toppy says, just joining in. So you guys are going to admit you were wrong about rates. Rates are higher now than we predicted in December. You might have missed the 6 episodes we've had since then. We've talked about every week that rates are definitely significantly higher than we thought. The prediction was somewhere around 375 would be our worst case throughout the year. And we've blown through that here in the first 6 weeks of the year. So hopefully that answered your question. Garrett had another one, a good one here. Can I afford a $450,000 house in this market with $130,000 income? I'm investing 20% of my income into my 401k. So 130 a year, let's call it $10,000 a month. It's a little bit more than that. So 20% you're putting into the 401k, so you have $8,000 a month. At 450,000, if you even qualified for a 0 down loan, which you're going to put some sort of down, but borrow 450, your payment's going to be $2,800 with an $8,000 a month income after your 401k investing. You can absolutely afford that. I should say you can absolutely qualify for that. You know your spending, you know what you can afford. But from that end, I would say your debt to income ratio is in a reasonable range. I see no reason why you couldn't do that.
Good stuff. Maddie comes on and says, good stuff as always. $10 super chat. Thank you, Maddie. And Josh, I want to go back to the interest rate thing too, right? We're here not telling anyone that, that it's certain what we think, right? We're just using best educated guess based on people that we read, experience in the market, so on and so forth. And so, yeah, rates are higher than I thought they would be. Now, I will go on and say, I don't think rates are going to stay high for forever. And I don't think rates are going to move very much from this point. I think you're probably seeing kind of that number that we're going to kind of pivot around, right? Might go up a little bit, might go down a little bit, but this is going to be the norm for some time, would be my guess. Again, it's a guess. It's nothing is certain. That's why you've got to do
educated guess.
Yeah, do what's right for you. And I'll throw it out there. I don't think a crash is coming. Do we need a pullback in prices? 100%. We need a pullback in prices to some extent. You've got to have some sort of correction. Market can't continue like this. So at some point, the market's going to correct and people are going to say, Jeb, you said home prices were going to go up. I do think long-term home prices are going to continue to go up. Real estate is a great long-term hold. But at some point, prices will pull back. And I'll get caught being bullish and saying that, the market was going to appreciate. So I'm happy to admit when I'm wrong. But at the moment, the Fed is under the gun. There's a lot of volatility. No one knows what the heck's going on. So until they really follow through with a plan, that volatility is going to cause some confusion. And with that, rates are going to be at risk. So
we're looking at GDP being under 2% for the first quarter here. That will catch the Fed's attention. Sub 2% GDP is not inflationary over the long haul. The Fed's going to be tightening. That's going to have some impacts here. It's generally buy the rumor, sell the fact. We've seen the big move, and the Fed hasn't done anything other than stop buying treasuries and mortgages. Generally, historically, we can show you the charts. Once the Fed starts tightening, interest rates improve. I'm not sitting here saying that interest rates are going to improve. We have to look at that inflation horizon also. Next month should be the last super hot read we have on inflation. That doesn't mean it's going back down to 2%, but when you see it start moderating to 6% and then to 5.5% and then to 4.5% month after month, you'll see bonds react accordingly.
Good stuff. I just threw the link to Spotify for the podcast in the comments as well. So anybody wanting to, or that's missed me saying this, Josh and I created a podcast to talk about housing topics in more detail. So you can listen to them outside of video format. We address some of the things we talk about here, just in a lot more detail, a lot more granular, if you will. It is not me taking a video that I filmed on YouTube and just taking the audio and putting it on YouTube. It's a completely different conversation. We go over an outline and talk about things we think's important that you want to hear in that. So if you're considering buying a home, considering selling a home, going through that process, first time home buyer, don't know where to start, it's all in there. And we address it for you. So do it. If you like it, rate it. I know nothing about podcasts other than I listen to them. So my understanding is if you rate it and all of that good stuff, it helps, again, kind of like YouTube, helps people see it. So that would be appreciated. So let's see if we can find some questions here. Yeah. So what is it? Ian.
John X.
Is it Jean? Is it X Ja? I don't
Well,
know.
remember we had Xi, the Chinese president, was Xi Jinping, so Jian. You
Look
like my
at you,
Chinese?
bro. Yeah, that's pretty
They're probably
good.
going, Whitey has no idea what he's talking about. And I'm just
Look
going
at
with what other names and trying to extrapolate from
Yeah,
that.
so Zillow has once again updated their forecast. It's some crazy number, like 21% or something. I mean, I guess you could call it crazy, but honestly, at the moment, it looks like a realistic forecast just based on what I'm seeing locally. Now, things can't continue like that, right? I just mentioned that. So,
Well, Jeff,
we'll continue to keep you updated though.
do you remember the conversation we had? So when you get to like late October, early November, holidays are coming. Buyers generally tend to just put it off till the next year. So they start asking, okay, 2021 was nuts. What's going to happen in 2022? And we said it's got to moderate, hopefully somewhere in the 7 to 9% range. And I said, unfortunately, I think that might be wishful thinking just because of the supply demand imbalance. And here we're looking like I just don't know where we're going to get the sellers to come from. If anything, for us in California, where it's pretty much built out, there's not a lot of new construction. Like I don't think the prices are supported by the fundamentals, but if you don't get enough additional supply, then the prices continue to go up. It's sort of like diamonds. There's nothing intrinsically valuable about diamonds other than their scarcity and really good marketing behind it. Like we have scarcity because people aren't selling their homes. Until more homes come to market and we have enough people more people willing and able to buy them, we're going to see prices continue to go up, even though the numbers kind of look a little crazy. So I don't know necessarily see something that's going to change that supply demand imbalance. Jeb and I both think, I don't know if it's a year from now, 3 years from now, but rates are going to come back down. And you go, well, like it's almost good as a mortgage professional. It's beneficial for my bank account to have lower rates. For the economy and my friends and family and clients being able to afford, it's better that rates be a little bit higher if they put the brakes on the market. So far, it hasn't. We're getting like the worst of all possible worlds in that the buyers are paying more in higher interest rates, but they're not seeing less competition in terms of homes. And the only reason for that is there aren't enough homes on the market for them to sell, and that's or for them to buy, people willing to sell that they're able to buy, and that's what we're looking at. We all agree the numbers are a little wonky. We've reached the high end of affordability of where we've historically hit in California, and every sub market around the country, different states, different counties, different cities, they all have different numbers. But pretty much California has reached what has historically been the low end of affordability, or within 6 to 12 months of it. That's not a good thing. So if Zillow is right and it's a 15 or 20% number up from here, like just think of how crazy those numbers look.
No, absolutely. Chris is asking, you mentioned smart people. Would you mind sharing top 3 people when you mentioned reading smart people, Josh?
Follow John Malden, because John Malden is not only a smart guy, he follows tons of smart people. And just following his list, if you followed only one person, Malden has a free newsletter, and underneath
Good.
that, he will introduce you to other people. It's very good content. And then he will reference other people who have either paid or free content. Jeb and I had a conversation at lunch yesterday. George Friedman runs a company called Geopolitical Futures. And like, what we see on the news is so far from what really happens and what the options are for world leaders, both ours and other countries, that seeing someone who is like, a neutral, dispassionate observer of geopolitics, it's super interesting. And that's someone that I would have never found if it weren't for John Malden. On the interest rate side, there's a couple of people that it's probably too inside baseball. I don't know that it's folks that you would be interested in. So start with Malden. Jeremy Grantham is a guy that he talks a lot about that is good. He's a little bearish on a lot of things. I think
A
more so
little.
than is justified. A little more so than is justified. But he's a smart guy. Harry Dent, same thing. Harry Dent is big on demographics and looking forward. But it's important to read a lot of people and then watch over time and see what their biases are, what their blind spots are, and then formulate your beliefs and your opinions from there. And I say that Jeb and I are those people. Every human being is biased. So you need to find people that are smart and as unbiased as possible, and then figure out what their biases are and sort of titrate or triangulate your opinion from there.
Yeah, form a hypotenuse around them.
Yeah.
Instead of triangulate. Let's see here. Chris had another good question, so I thought I would click on it here. If people are locked in on a 30-year fixed in the 2% range, do you think they will sell? That's a good question, and that's one of the reasons that I believe inventory is going to continue to be a problem in this environment. If I were a seller, for example, I'm not, but if I were, and I were looking at the market, say now, home prices are higher, interest rates are higher. That's really hard to take a double whammy on both of those things. Now, let's say interest rates or home prices pull back. It's a little bit more affordable to buy a home, but interest rates are still higher. I've got to figure out based on where I am if that makes sense or not. A lot of people out there are going to have that bias towards, you know what, my interest rate is super low, free money. I'm never leaving this place. I'm never selling it. And so I think that's going to play a factor into people wanting to keep property, and whether they hold it as a rental or they keep it as their primary, and that's going to put a strain on supply. I mean, I do think that's a factor, and that's something I've talked about several times on video.
This is on the same subject. We've already kind of given the answer, but Mandeep says, any indications when inventory will go up or the housing price go down? Those are the two things. Inventory has to go up for home prices to go down. And I'm all ears. If someone can tell me where the additional inventory is coming from, I would like to know. I would like it for my buyers. I would like it to be easier for my buyers. I would like for them to not get in bidding wars and have multiple homes to choose from. And unfortunately, I don't have the answers right now.
Good stuff. Let's see. This is a good question. What happens to your property taxes in California if you do a lot split? Does Prop 13 still apply, or is the property reassessed? So I don't know specifically 100%, but my guess would be they would reassess the value of the improvements you've made to the property on top of where your base rate was at that time. So your taxes are going to go up, but they aren't going to reassess the entire property at, say, market value, right? That's what Prop 13 prevents. In fact, Prop 13 prevents your property taxes from going up more than 2% a year. So I'm not sure how the assessment and all of that will work with the Prop 13 thing. Yeah, and the lot splitting, right? That's something that's all new to California. Josh, anything you want to add on that? I mean,
no, I would research it. I wouldn't even step into it because I think when you're sitting here, Prop 13 applies to commercial property. It's not just your primary residence. So I can't think of any reason why you would get reassessed. You own the property right now. It's just getting a separate parcel number. And I have a client that actually they bought a property in Paris, going back to a manufactured home. It was a giant lot with a manufactured home on it. They split it into 3 lots and have sold the 2 other lots off and still have a big lot with their manufactured home on it. Maybe I'll reach out and find out. And I think I can just look up the tax bills and see if they were reassessed and increased the taxes versus what the 1/3, 1/3, 1/3 was for the underlying lot.
good stuff. Good stuff. Devi says, is this the good time to sell primary residence in Cupertino, California? Pull out a lot of equity and rent and wait to buy when home prices settle down a bit. Very confused. Good question. I wish I had the answer to that. What I have, you guys have heard me say this. I've got multiple people in my database that have sold property with the idea that home prices were going to pull back. This is going back to 2018, 2019. Home prices have peaked. We're pulling, we're going to sit on the sidelines. They still don't own property. So it's a difficult question in that regard because you don't know where home prices are going to go. You're in the Bay Area. I mean, you're in near Cupertino is, help me out here, Josh, Silicon Valley area. Listen, a lot of money there, a lot of startups, a lot of companies going public, a lot of cash. There's going to be demand for that area for some period of time. And so my guess is you're probably sitting on a property that could continue to appreciate. Now, the question is, when you are looking to buy, what are you looking to buy? What are you looking to rent? Because those are questions that you need to ask yourself. What's out there that's even, what is it that you would want to buy? At what level, what price point are you thinking? Right? And where are prices now, for that same property? How much would the market need to pull back? If you're saying something crazy, 50%, then I would say no chance. If you think 10, 15%, that's a possibility. But does it pull back from 10 to 15% higher than where we are now? Does it pull back, 30%? We don't know when the pullback happens. And that's the thing. So you've just got to be prepared if you do that you might be a renter for longer than you think you will be. And that home prices might not ever come down to the level that which you think they are going to. So there's a lot of what ifs there and a lot of things that you need to consider if you're making that plan. So unfortunately, I don't really have much to give you with regards to advice other than, you got to do what's right for you. But I think pulling out, sitting on the sidelines with the idea that you think the market's going to pull back is probably not the right one.
Yeah, you need to have balls of steel to do that one, because it's more often people that I've talked to have been on the wrong side of it and just couldn't get back in or couldn't get back into something similar. And depending on when you bought in Cupertino, you may have seen so much appreciation. You also have capital gains on that. If it's a residence and you're married, you can exclude 500. But we ran through some numbers with multiple scenarios, Jeb, where lots of people have more than $500,000 of gains in their homes and will be
something that nobody takes into account. Everybody thinks that all that money's just coming to them. No. The government's going to get theirs. Yeah. And so you might not walk away with as much cash as you think. So all good things to throw in there. We're reaching that point, guys. It's been almost 2 hours. I am going to once again ask you guys to hit that thumbs up. You guys did really well in the front of the show. Before 45 minutes were in, I think we were over 100 likes. And then since then, the ball's been dropped. So I don't know what happened. But clearly,
maybe their leader wasn't directing them properly.
Maybe the content wasn't as good, Josh. Maybe I can only have you on for the first half
of
the show.
Maybe
somebody else for the second half.
No one wants to like when this guest is on.
So hit that thumbs up. Help us get out to more people. More people see it. Feel free to subscribe to the channel if you want to stay updated on everything real estate related. There's a scroll on the bottom of the screen if you want to get connected with a professional, an expert, whether it's a mortgage lender, a real estate professional, anywhere in the United States, can do that too. Lastly, I'll mention the podcast. I want to mention the webinar, right? Before I mention the podcast, last Thursday we did a webinar. We had about 75 or so people sign up for it. 30 plus people ended up coming into the webinar. We appreciate you guys that did come in. We are going to put it out there for those of you who want to see it. Next week, we'll have a link for you guys to go and just sign up and you can watch it whenever you want to watch it. But we got really good feedback. People felt there was a lot of value provided in that. So we do want to put it out there for you. So if you did miss it, just know that it's coming again. Just it'll be in a little bit different format for you to watch. Lastly, podcast. It's on Apple. It's on Spotify. It's on, I think, every platform outside of Google at the moment because they're holding us
they don't like us
for whatever reason. The Educated Home Buyer, where you can find it. Go listen to episode 3. Should you buy a home in 2022? It's good stuff. A little long. Put it on 2-speed, 1.5 speed. Listen to it quickly. Get a lot of good information. But Josh, I'll end the show with you, buddy. Anything you want to say?
No, just keep asking good questions, keep doing your research, and don't feel pressure to do anything, to sell, to buy, to make a decision. Go through it, get yourself educated, and make sure you are comfortable with it. The most important thing is, over the long haul, most people should own a home, but they should own a home when it's right for them. So ask the right questions, get answers that you're comfortable with, and just live with your decision. And if the answer is to not own, just make sure that you're making a plan for savings. The one gentleman who said he's saving 20% of his income and thinking about buying. If you're not renting, I think that's a real safe number. You need to be putting 20% of your income away if you're renting versus owning.
Good stuff. Thank you guys for being here. We will see you next week.